Top three things in my notebook this morning away from that VIX, volume, and the 10-year bond yield. So first on the VIX, front-month VIX is signaling immediate term trade overbought in as much as the S&P 500 is testing immediate term trade oversold, and so is the Russell 2000. So what does that mean? Within the context of a bubble call, that means we're oversold on S&P 500 and we're overbought on volatility. That does happen. Now, the flexible risk manager understands the bubble quite well. So again, you know where to cover and you know where to reshort them. So again, use the risk range on the S&P 500. That's 1982 to 1999. And yes, 1999 is indeed a lower high in as much as the VIX is signaling a series of higher lows with trend support at 1134. Now finally, on the volume side, again, we get right back to where we were. On the down days, we have what? We have more volume. On the up days, we have what? We have less volume. So again, we look at monthly volume, we look at on a 3-month basis. If you look at U.S. equity total market volume yesterday, it was up 9% versus the 1-month average versus the 3-month average, it was up a full 3%. So again, up on the down day. That's why we're so concerned about the liquidity of this market. We don't think people will be able to get out when it finally goes down for real. And then finally on the 10-year bond yield, fascinating to watch the leaks yesterday that the Fed is going to indeed change the goalposts one more time, and after that they'll do it again. But again, what they want to do is change the language. They need to change the language because enough people have called them out, and again, they're not elected, so they're not really accountable, but when they get called out, it is a political issue where people have said, hey, look, you seem to have calendar-based guidance. So in other words, there is an expectation for the dots, or an expectation of a point in time where interest rates will go out. So the Fed doesn't want that. They've got to get that out of the way. What they'd rather be is data dependent. Now, some people say, oh, if they're data dependent and the data is bullish because we're all bullish, that means interest rates are going up. No, 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 no. When they go to data dependent, when the data gets horrendous, like the MBA mortgage purchase application data this morning, they get more dovish. So again, data dependent is code word for we can get more dovish. Top three things.